4%. That's what the best high-yield savings accounts are paying right now. Sounds pretty good, right? Your money sits there, completely safe, FDIC insured up to $250,000, and every month you watch that interest trickle in. No stress, no market crashes to worry about, no waking up to check your portfolio. But here's what nobody tells you. That 4% you're celebrating, it's actually making you poorer. Not right now. You won't notice it this year or next. But 10 years from now, when you compare what you have to what you could have had, the difference won't just surprise you. It might genuinely upset you. Quick disclaimer. I'm not a financial advisor and this isn't financial advice. Always do your own research before making any investment decisions. Today, I'm going to show you exactly what happens when you put $50,000 in a high-yield savings account versus two specific dividend ETFs over 1, 5, 10, and 20-year periods. But the real revelation isn't just about which one wins. It's understanding which type of compounding actually builds wealth versus which one just treads water. Let's start with why high-yield savings accounts feel so good right now. The Federal Reserve has been cutting rates since late 2025, but the best accounts are still hovering between 4 and 5% APY. Put $50,000 in there, and you're looking at roughly $2,000 in interest your first year. That's free money for doing absolutely nothing. And there's real value here. Your principal is protected. You can access your cash anytime. If the market crashes tomorrow, your savings account doesn't budge. For emergency funds, that 3 to 6 months of expenses everyone should have, this is exactly where that money belongs. But here's the problem nobody's talking about. Inflation just came in at 2.7% for November 2025. That sounds manageable until you do the math. Your 4% savings account minus 2.7% inflation leaves you with a real return of about 1.3%. Your $50,000 isn't really growing by $2,000. In terms of actual purchasing power, you're gaining maybe $650. And here's where it gets worse. High-yield savings rates aren't permanent. They track the federal funds rate, and the Fed is projected to keep cutting. By mid-2026, many analysts expect rates to fall another 1%. That 4% you're earning today? It might be 3% by next year, then 2.5%. The moment you lock in your financial planning strategy around high-yield savings, the rules change. This is the fundamental flaw with savings account compounding. You're compounding at whatever rate the bank decides to pay you, which is always going to hover just above inflation at best. Your money isn't actually growing. It's just keeping pace with the rising cost of living. 20 years from now, your $50,000 will have more digits attached to it, but it'll buy roughly the same amount of stuff. Now let's talk about what happens when you compound differently. There's an ETF that most passive income seekers have heard of. It's called SCHD, the Schwab US Dividend Equity ETF. Right now, it's trading around $27.50 per share with a dividend yield of 3.8%. Expense ratio of just 0.06%. Over $72 billion in assets. On the surface, that 3.8% yield looks worse than your 4% savings account. Why would you take on stock market risk for less income? But that question reveals the biggest misconception about dividend investing. The yield isn't the return. The total return is the return. SCHD's 10-year annualized total return, meaning price appreciation plus dividends reinvested, is roughly 11 to 12% per year. That's not a cherry-picked good period either. That includes the 2022 bear market when SCHD dropped over 3%. It includes the volatility of 2020 and the recovery since. Let me show you what that actually looks like with real numbers. Harry puts $50,000 in a high-yield savings account earning 4%. Year 1, he's got $52,000. He feels good. Year 5, he's at $60,800. Not bad. Year 10, he's sitting on $74,000. 20 years of patient saving? $109,500. His money more than doubled. Now Harry's friend takes the same $50,000 and puts it in SCHD. Assuming SCHD continues its historical pattern of around 11% annualized total returns, which obviously isn't guaranteed. Year 1, he's got $55,500. Year 5, $84,200. Year 10, $142,000. 20 years? $403,000. The savings account doubled Harry's money. The Dividend ETF might potentially create 8 times his original investment. This is why understanding the difference between these two types of compounding is so critical for long-term investing. But wait, I know what you're thinking. SCHD can go down. The stock market crashes. 2022, SCHD lost money while savings accounts were paying almost nothing but at least stayed positive. What about the risk? This is valid, and it's why time horizon matters so much. SCHD's worst single year since inception was that -3% in 2022. Its best was over 35% in 2021. The volatility is real. If you need your money in 2 years, you absolutely should not put it in dividend ETFs. The market could drop 20% right before you need it. But if your time horizon is 10 years or longer, history shows something interesting. Historically, over long periods, broad U.S. stock indexes have often delivered positive returns if you stayed invested. Not the Great Depression, not the dot-com bust, not the financial crisis. The longer you hold, the more the math tilts dramatically in favor of equities. And here's what makes dividend ETFs particularly compelling for compounding. Unlike a savings account where your interest rate changes based on Fed policy, dividend growth tends to follow corporate profits. SCHD's underlying companies have historically increased their dividends at around 10 to 11% per year. That means even if the share price went nowhere, your income stream would roughly double every 7 years just from dividend growth. Let me introduce you to SCHD's sibling, DGRO, the iShares Core Dividend Growth ETF. DGRO takes a slightly different approach. Instead of focusing on current high yield, it prioritizes companies with a track record of growing their dividends. The current yield is lower at about 2%, but the total return has actually been slightly better over the past decade, around 12 to 13% annualized. The expense ratio is 0.08%. It holds about 400 stocks compared to SCHD's 100. And here's the interesting part. Because DGRO focuses on dividend growth rather than current yield, it includes companies like Apple, Microsoft, and Broadcom that don't pay huge dividends today but have been growing them consistently. This creates a different compounding effect. DGRO might start paying you less in year 1, but by year 15, your actual dividend income could exceed what SCHD would be paying because the growth rate has been higher. Let me show you how this plays out with Harry's $50,000 again. Year 1 with DGRO, assuming around 2% yield, Harry receives roughly $1,000 in dividends. With SCHD at 3.8%, he gets about $1,900. SCHD wins initially. But fast forward 10 years, assuming both funds continue their historical dividend growth rates. DGRO's dividends might be growing at nearly 8% annually, while SCHD's grow at around 10 to 11%. However, DGRO's share price appreciation has historically been stronger, which means more shares purchased when dividends reinvest. By year 10, Harry's DGRO position, with dividends reinvested, could potentially be worth more than his SCHD position, despite starting with lower income. The crossover point typically happens somewhere between year 7 and year 12. This is the power of compound interest, working on multiple dimensions simultaneously: share price appreciation, dividend reinvestment, and dividend growth. Now here's the part that genuinely changes how you think about this. Most people approach this decision emotionally. They either love the safety of savings accounts or they love the potential of stocks. But this is actually a math problem with a time variable. The break-even point, where dividend ETF returns equal high-yield savings returns, even accounting for risk, is typically around 3 to 5 years. Before that window, the guaranteed return of a savings account might actually be worth more to you because you eliminate the possibility of losing money. After that window, every additional year is compounding at potentially 3 times the rate of your savings account. And unlike savings rates that could drop to 2% tomorrow, dividend growth at established companies tends to be remarkably consistent because cutting dividends is considered corporate embarrassment. But there's another factor most people miss entirely: tax treatment. High-yield savings interest is taxed as ordinary income. If you're in the 24% tax bracket, that 4% APY becomes 3% after taxes. Meanwhile, qualified dividends from SCHD and DGRO are taxed at the long-term capital gains rate, 0% if you're in the lower brackets, 15% for most people. For Harry, in the 24% bracket, his after-tax return on the savings account drops to roughly 3%. His after-tax return on dividend ETFs? Probably still around 9 to 10% after taxes on dividends and eventual capital gains. The gap just got wider. So what's the actual investment strategy here? First, acknowledge that both tools have their place in a complete portfolio diversification plan. Your emergency fund, 3 to 6 months of expenses, belongs in a high-yield savings account, period. The liquidity and safety matter more than returns when you might need that money tomorrow. Second, any money you won't touch for at least 5 years should at minimum be considered for dividend ETFs. The math is simply too compelling to ignore. A fund like SCHD offers you the best of both worlds, meaningful current income around 3.8% plus growth potential that savings accounts can never provide. Third, consider your psychological tolerance. Some people genuinely cannot handle seeing their portfolio drop 30%, even if they know it'll recover. If watching your retirement savings decline would cause you to sell at the worst possible moment, a smaller allocation to stocks with a larger savings cushion might actually produce better results for you personally. Fourth, think about income timing. If you need regular income now, SCHD's higher current yield makes more sense. If you're building for financial independence 20 years out and reinvesting everything, DGRO's lower yield but higher growth trajectory might serve you better. Harry ended up splitting the difference. He kept 6 months of expenses, $30,000, in his high-yield savings account, earning that 4%. He put the remaining $50,000 into dividend ETFs, splitting roughly even between SCHD for current income and DGRO for growth. 2 years later, his savings account had grown to about $32,400. His ETF position, after some volatility, sat at around $67,000. The total gap between where he'd be with all savings versus his split approach was already over $15,000. And here's what surprised him most. The dividends he received from his ETF positions, reinvested automatically, were already generating their own dividends. His money was making money that was making money. That's the version of compounding that actually builds wealth. The high-yield savings account was compounding too, just at a rate that barely kept pace with inflation. It was the financial equivalent of running on a treadmill, lots of motion, but you end up in the same place. 20 years from now, these two paths diverge so dramatically that the person who chose all savings might look at the person who chose dividend ETFs and assume they inherited money or got lucky. They didn't get lucky. They just understood that not all compounding is created equal. A few percentage points of difference compounded over decades creates a gap that no amount of saving can close. The question isn't really whether savings accounts or dividend ETFs are better. They're both tools. The question is which tool accomplishes what you're actually trying to build. If you're looking to preserve capital short-term, the savings account wins. If you're trying to build wealth over decades, the math has been remarkably consistent for over a century. Your money compounds either way, but only one way compounds into something that genuinely changes your financial future. If you want to see how combining different dividend strategies can accelerate your results even further, I break down the exact portfolio allocation I'd use to retire on dividends in this video right here.